Hey everyone, welcome back to the Economic Analyst channel. In this video, I'm going to try to demonstrate how the corporate bond interest rates and that corporate bond market is distorting the other markets of investment, notably the stock market and then the precious metals market. Now this chart right here shows the corporate bond effective yields, the yields to maturity, on the associated bonds for AAA, B rated, and then CCC and lower or junk bonds with their interest rates with the corresponding colors. So your AAA interest rates adjusted for the consumer price index inflation, annual inflation rate, is in red. Your B rated bonds are in green, and then your junk bonds are in this light blue, okay? And you notice how they've been trending downward ever since the COVID pandemics and government shutdowns have occurred. But a lot of this I'm going to go over on why I think that is occurring and where that's going to go from here. So just stay tuned from that. But notice that adjusted for inflation, all corporate bond interest rates are yielding a negative rate of return, except for junk bond interest rates. And this may sound counterintuitive. It may sound insane, because why would any investor buy a security or buy any type of investment that is giving them a real term negative rate of return? And, I've produced videos in the past talking about that and maybe talking about the psychology of this, but I'm actually going to break it down in the mathematics on why the corporate bond structure, I think, is headed this way, and to give us kind of an idea of when this will reverse, because as economic logic will dictate, this can't go on forever. Now, something's got to give. Either the consumer price inflation numbers start coming down and the real returns on these bonds start going up to justify these low interest rates, or these low interest rates start to head higher, and therefore the real return increases that way. But that would force a sell-off in the bond market and require certain reversals of trends that we're observing in the other markets. Now, one of the things that I think is driving this drive lower here is this dark blue line called the US dollar index. Now, this is to be distinguished from what you can go on Google and just type in dollar index DXY chart. This is the nominal broad US dollar index. It claims to be a better version of that dollar index because it measures it against other more currencies than just what the typical one does. And not only that, it adjusts the weights yearly instead of never adjusting the weights to those currencies. Now, according to this broad US dollar index, the dollar has rallied about 5% since in the last 6 months. Okay, so in other words, there are a group of investors that are buying dollar denominated assets. Okay, and by buying and purchasing these dollar denominated securities, it is actually increasing the value of the dollar, because first they must go out on the foreign exchange markets and buy the US dollar, then use those dollars to buy the associated securities. And by doing so, they're circulating dollars outside of traditional US markets, which is increasing the value of the dollar. And not only that, it is keeping price inflation from spiraling out of control or even going higher, if you can imagine it, because despite all of this, the consumer price inflation here is still at a whopping 6.8%. But most importantly, it is keeping these nominal rates. Now, well, this is real rates. These are adjusted for inflation, but the nominal interest rates and thus the real interest rates on these bonds lower than what they otherwise would have been, okay? So then the question becomes, well, who is buying this? Well, one of the things I want you to take note here is that the red line here is the 30-year Treasury yield. Okay, it's the yield on holding a 30-year federal government Treasury bond. And notice how it strongly correlates with the AAA corporate index yields that is compiled by Bank of America. Okay, it's uncanny how close this is. Okay, so wherever these corporate bonds go, especially on high-grade AAA corporate bonds, they tend to correlate very strongly with long-term government treasuries. Now, it's often been viewed that this 30-year government treasury has been looked at as what is called the risk-free rate. The U.S. government has never defaulted on its debt, so getting this rate of return is almost guaranteed. As a matter of fact, in common markets, it is looked at and is looked at as being guaranteed. Okay? And I want you to keep note on that, on where this is going here. But wherever, if the corporate bonds are driven lower, I believe they're being driven lower because the real rate of return on government bonds are being driven lower. So there's this chasing yield. So then who is buying all of this government bonds? Well, right now, if we take a look at the U.S. government's debt to the penny, so if we go to treasury.gov and look at the official U.S. government debt, we see right now that total federal U.S. government debt right now stands at over $29 trillion. Now, let me be a disclaimer here. $6.4 trillion of this money is actually held by the government. It is, most of this, if not all of this, is actually put into the Social Security Trust Fund. What does that mean? The taxes, the payroll taxes that we pay that go to Social Security is used to purchase this government debt, and that is looked at as an investment. These are special treasury bonds that yield really, really low rates of return. So the interest rates are ultra low, even lower than what you get on the market for treasury bills. And this is held into the Social Security Trust Fund. Therefore, this amount of debt is not circulating out among the public to be bought. Instead, what is actually circulating amount of out to the public is $23 trillion. So there's $23 trillion out in the global markets and the U.S. markets circulating around that's got to be bought and held. If they're not, and more of this gets circulated around, the interest rates go up. Now, doing some simple mathematics, one of the things that we can look at is start compiling who owns this debt. How much of it is owned and how much of it has been taken out of the market to get a better idea on what's actually floating, okay? So the first thing we need to look at is the foreign holders of Treasury securities, okay? Now, this is not, this data here, this data that I'm giving you here is not complete. It's not the full data of every single investor in every country that holds U.S. debt. These are just the major foreign holders. But the total comes out to, at the end of October, at $7.6 trillion. And if you notice, this has been trending up since about May of 2021. It's actually been trending up since earlier than that, but particularly starting in June, there was a huge buy-off of U.S. Treasury securities here, okay? Now, of which, of this 7.6 trillion, 4.2 is actually officially owned by governments in the associated countries around the world. So these countries' central banks are holding them most likely as reserves, and by purchasing them and holding them as reserves, they're cycling them out of the market. In addition, another $3.4 trillion is being held by the actual private investors that are not in the U.S., okay? So this is the demand for government debt, our government debt, that's not even in the U.S. This is outside of the U.S., which again cycles out all of this money out of the U.S. economy and is one of the reasons why this dollar index has been rallying by 5%, which is huge in any type of currency market. Now, I'm willing to bet that if we put this out to December, this number is probably closer to $8 trillion, okay? And the reason why I believe that is because if we take a look at the corporate bond interest rates, they've only gone down. They've only gone down as of November. They're not going up, okay? Government bond interest rates are still trending lower even after October's data has come in. So somebody's buying them. My guess is that foreign investors and foreign holders of this debt are buying them. So let's round this up and say it's $8 trillion. Out of this $23 trillion that's held by the public, $8 trillion is held completely abroad, out of the side of the U.S. So now we're down to $15 trillion that's left. Well, now we have to remember that nearly $6 trillion is held by Federal Reserve banks. So the Federal Reserve uses Federal Reserve banks to purchase public debt, and by doing so, by purchasing this public debt, they're cycling that government debt out of the market. So now we're not down to $15 trillion. Now we're down to $9 trillion actually, floating around still that we have not accounted for. And just to keep clear here, out of this $5.9 trillion, nearly all of it is actually U.S. Treasury securities. So this isn't short-term debt. Nearly most of it is time denominated. Okay, so it's either one-year government bonds, six-month government bonds, and so on. They are not short-term commercial paper of government debt. But that part's obvious. Then we have to take a look at what's held on the balance sheets at commercial banks. So here, out of the commercial banks, out of Treasury and agency securities, there are two categories. There are MBSs, which are mortgage-backed securities. That's not government debt. And then there's non-MBSs, non-mortgage-backed securities. That is your federal government debt. Those are your Treasury securities here. And of that, $1.6 trillion is held at the banks. So when we add this all together, there is not really $23 trillion circulating out among the public. There is $7.5 trillion minus what U.S. private investors hold and buy. And that number, we just don't know. But it has to be a fairly large number. Why? Because the interest rates on government debt is so low. It is yielding a negative rate of return. If the government debt, the yield and the interest rates on government debt is approximately 1.9%, right? But your CPI, consumer price inflation, is 6.8, then your real return is actually -5. You're losing 5% of your wealth every single year by holding this debt, okay? And this demand for debt is there because, like I said, you have the Federal Reserve that has purchased $6 trillion of this $23 trillion. So that is 25% of the debt. Over 25% of the debt is held by the Federal Reserve. Then you have to factor here that over 30% of the debt, really 33%, a third of the debt, is actually held abroad by federal governments. And then, not only that, you've got another, another 7.5%, almost, 7% debt that is held by commercial banks. So 65% of our debt, of the federal debt, is not even in the market, and we haven't even gotten to the private holdings of investors. So this has driven government bond interest rates so low that it has driven the markets for corporate bonds also low. And by doing so, it's distorting these bond markets and making these bond markets yield negative real returns because so much of it has been cycled out by these forces. Now, we can't control what happens with foreign investings of US dollars. Why in the world is a bunch of foreign investors buying U.S. debt? Well, the likely reason is because of the pandemic, okay? The fears of government shutdowns in their countries destroying their economies is making them flock to U.S. assets and creating a demand for the U.S. dollar versus their currencies, which is why the dollar is appreciating so strong. Now, why am I telling you all of this? Well, it's ultimately to get to this point right here. This chart is something that I compiled, and the two graph lines on this chart, the blue represents my gold valuation model, okay? And then the red is my stock market valuation model. Now, the gold valuation model is basically taking the old translation of M1, So basically, your demand deposits, your currency in circulation, and then counting for other checkable deposits. And factoring in the consumer price inflation. And then comparing that or dividing that by the gross domestic product. And by doing so and dividing it against that gross domestic product, okay, you're able to get sort of a valuation of where gold should be, okay, based off of its gold price. So the higher the price, the higher the valuation. But when we reach above this black line, which is marked as zero, this zero mark kind of tells you whether gold is under or overvalued. Okay, so based off of this compiling chart, which I'll probably adjust in the coming months, gold has been undervalued for some time. Now the question is why? Well, I believe one of the major determining factors on what is distorting this gold market is this red line, which is the valuation of the stock market. Now in the 70s, the stock market was undervalued compared to the gross domestic product. So taking the Buffett indicator and taking the aggregate stock market capitalization, which I'm using the Wilshire 5000 as a proxy for this, and dividing that by gross domestic product, the nominal GDP rate, you can get an approximate valuation of what the stock market should translate as, okay? You can take a look that the stock market capitalization can be translated into the net income or GDP of the entire economy. And typically speaking, the stock market capitalization to gross domestic product should be about 1-to-1. So however much income, net income we generate as measured by gross domestic product should be about what your stock market is, how much money is actually invested in the stock market as measured by the Wilshire 5000. Now in the 70s, the stock market was grossly undervalued. So when the stock market started to go into a bull market or reemerge out of its bear market in the 80s, this caused the gold price to drop. Why? Because money was flowing out of the precious metals market as a safe haven and flowing into growth markets such as the stock market because the economy was recovering from the high inflation situation going on in the late 70s and early 1980s. And since then, there has been a negative correlation between stocks and gold. When stocks go up, gold goes down. When gold goes up, stocks go down. Okay? So notice here, it makes sense that gold was most undervalued at the year 2000 when stocks were the most overvalued. So according to this measurement, the stock market was overvalued by a whopping 40%, and gold was undervalued by a whopping 60%. Then in the 2000s, we see the convergence as the stock market corrects from this historic bubble and then the collapse in the early 2000s. We see gold's bull market reemerge as money was flowing out of the stock market and most likely into precious metals, which caused a huge gold market and precious metal rally that lasted all the way until about 2011. And then gold became a little bit overvalued here. So according to this measurement, gold became about 20% overvalued. But as the stock market started to recover from its second collapse in 2007 and 2008, that signaled the end of the gold bull market, and you can see from here on out, going to present day, as the stock market has soared in valuation and has reached record bubble territory, gold has now reached its lows that it was in the early 2000s, where it is now significantly undervalued, okay? Now, the reason why I think is that this is translating here, and I'm bringing to you to this chart, I'm going to bring this all together, that I believe that what's distorting these markets is the bond markets. I believe that the low bond interest rates are driving money into the stock market, especially for low government yields. And by doing that, it is lowering the risk-free rate, lowering the opportunity cost of owning stocks. And by lowering the opportunity cost of owning stocks, it's increasing the net present value of owning stocks, which is driving the stock market to record highs. And in this chart here, I used the 30-year yield and the 5-year GDP growth rate and took the 5-year GDP growth rate that is, how much has the economy grown in 5 years on an annualized rate, and divided it by the 30-year Treasury yield, and multiplied it by GDP to approximate what the stock market should be valued at. And if you notice here, the orange line is that market valuation calculation that I'm using, and the blue line is the Wilshire 5000 stock market index. You can notice here there's pretty strong correlation between the two. In other words, what's driving the stock market to new heights right now is that investors are pricing in these ultra low interest rates. And by pricing in these ultra low interest rates, especially using what has been looked at as the risk-free rate, the federal government's 30-year Treasury market yield and market interest rate, that is driving prices of the stock market haywire. And so according to using the 30-year Treasury bond as the measuring stick, it doesn't really look like the stock market is overvalued. If, as a matter of fact, it looks like the stock market is slightly undervalued. But the truth of the matter is that these markets are distorted. And when we take a look at the stock market valuation to GDP, to the actual economy, the stock market is grossly overvalued, and is actually overvalued by more than 2 to 1. That is probably a more realistic way of looking and valuing the stock market that right now investors are just not analyzing. They are being lulled into this false sense of belief that the market still has room to grow, and they'll continue to buy into it. But if you notice here, this isn't the first time this has happened. This happened again in 2008, 2007, and when the collapse of the markets happened in 2007 and 2008, that's when we started to see the correction in the stock market, which was followed by the correction in the stock market valuation. So, in other words, what's probably going to drive these markets to new heights is one of two things: low interest rates and or a stable economy. But if any one of these give way, aka if interest rates start to go up, then what will happen is that the stock market valuation will drop. And when it does drop, it's going to plummet. It's going to cause a crash inside of the U.S. stock market. And then that will cause a correction in not only the stock market, but it will also cause a correction in the gold market and signal the next gold bull rally as money is flowing out of the stock market and into gold. Now, you might be thinking for a second and might get skeptical and say, wait a second here. Shouldn't low interest rates and money printing be propping up the gold price? Because isn't the opportunity cost of owning gold bond markets and interest rates? Well, you can look at that, and there's a good sound conventional logic to it. But the question is that interest rates are low and distorted. The money it also lowers the opportunity cost to owning stocks, which is causing that stock market investment to go on. And when you have a rallying dollar, which is driving money into those dollar-denominated assets, usually through debt, through corporate and government debt, then it's actually not flowing into precious metals. The bond market is actually competing with precious metals as a sort of alternative safe haven. In other words, instead of people rushing to buy gold, they're buying bonds. When that reverses, when the bond interest rates start to go up, that means money is not going to just flow out of the stock market. It's also going to flow out of the bond market, which means that the conventional means of earning an investment rate of return is changing. And what they are going to do is seek more value safe havens. Now, bond markets have been traditionally looked at as value safe havens because the rate of return is almost guaranteed, especially among government debt. But if that were to change and interest rates were to start to go up, then the prices of bonds drop and investors suffer losses on bonds, which can cause a run on bonds, meaning that a lot of investors start dumping federal and corporate bonds in the U.S. market, raising those interest rates, and then that will then cause the stock market to collapse. And the outflows of that money has to go somewhere, most likely because of the instability and because of the economic instability that represents, raising the likelihood of credit defaults because the cost of borrowing has increased, will more than likely cause that money to flow into gold. And in my opinion, until we see these forces change, gold is going to remain undervalued and stagnate. The bull market for gold, in other words, has not begun yet. So then the question becomes, well, what happens if the stock market were correctly valued according to the 30-year Treasury bond rate, which is dictated by the consumer price inflation? Well, if we were to just take the 30-year Treasury bond rate and analyze it compared to its historical performance on a real return basis, we can use the AAA corporate index effective yields because of the strong correlation between the two, between the AAA corporate bonds and U.S. 30-year Treasury rates. And we notice here that when we follow this red line, that in history's times past, it has trended very close to the inflation rate. Very close. It's maybe a little bit more of a premium to the inflation rate, but just slightly. And now it's heavily negative. So if we were to price government bonds at, say, 7%, which is just above the annual inflation rate now, we can see that the stock market would actually collapse and the valuation of the stock market would drop the Wilshire 5000 from its record high of over 47,000 index points all the way down to about 17,000 if that were to occur today. Now, will that occur today? No, it won't. Forces will not just change overnight. Now, there can come a sudden change in investors' outlooks on inflation and cause money to outflow, but it is highly unlikely that in the course of 3 months that it would be this severe. More than likely, it will be more of a gradual change. And this gradual change will instead cause the market to correct over time. Now, that being said, this is assuming that the correction occurs now. It starts to occur in, say, the beginning of 2022. There's no guarantee that it will. But with the Fed unwinding their asset purchases of Treasury securities and mortgage-backed securities, that will more than likely put upward pressure on these interest rates and may start the reversal process to occur. But it's anybody's guess on how fast or how slow that will take. And to give you a more realistic look, not to say that this is probably going to be correct, but to give you a more realistic look, we're probably just going to see a dragged out bear market of the U.S. economy and a somewhat correction in the stock market, or more than likely a topping off of the stock market for some time in the next year or two as interest rates adjust upward slowly, okay? And this slowly upward adjusting interest rate may then cause the gold market to start to slowly adjust upward and correct. So we would see a reconvergence starting on these drastically opposed valuations of the stock market and the gold market as gold prices start to increase and the stock market at least stagnates to the economy. But I don't think it would result in a severe change yet. I do believe, though, that if interest rates rise to a point that it signals the bursting of a credit bubble inside the U.S., which I have made previous videos attempting to calculate when that will be, AKA, I'm guesstimating that if the Federal Reserve were to raise the Fed funds rate to 1.25%, that would trigger the crash. Then yes, that will collapse the stock market, which will also signal a reversal of funds eventually flowing into the precious metals market to, reach the safe haven status. Much like that happened in 2007 and 2008. But now you have to remember that in 2007 and in 2008, if I were to bring up the gold price here, and I'm just going to bring that up right quick just as a frame of reference. In 2007 and 2008, we did have a correction in the gold markets, a very sharp correction. And this sharp correction was caused by the credit bubble burst, okay? So as banks became strapped for cash, they would sell off a lot of their holdings of precious metals and their investments in those securities on the COMEX and the exchange funds, the futures. They would sell those securities, and which caused the gold price actually dropped by some 25%, almost 30% in the course of 6 months as cash became, ironically, there became a shortage of cash, a shortage of liquidity in comparison to the aggregate amounts of debt. So if we do suffer a sharp credit crunch, we could see a correction in the gold price, but this correction will be followed by a swift bull market as investors who have dumped their assets will also rush to purchase the precious metals. So the supply may increase temporarily, but then the supply is going to escape and Gresham's law is going to take place where bad money drives out good. In this case, gold will reach a shortage again because it's the good money. Its undervalued status makes it easy to buy at discount price at very cheap prices, which then results in a shortage, which then drives up the gold price. So more than likely, we're going to see a correction, but it's going to be a slow correction in these two markets where gold slowly lifts over time and the stock market either stagnates or slowly drops over time. And then when the credit bubble commences and collapses, say sometime in 2024 or 2025, depending on how fast the Fed raises rates and how unstable our economy becomes, especially in the debt markets, that will then cause a sharp reversal of the valuations and cause the real precious metals market to begin. So now is the grace period time to buy precious metals. It's also time that you can still invest in the stock market if you can find value-safe investments, and they are there. So when the stock market starts to correct and interest rates start to go up, it's not like all stocks go down. Just the ones that are extremely overpriced will drop first before the value safe areas, the ones that have been very much holding to their intrinsic value, or however you decide to use value investing, which you can use your price earnings ratio and the book value and calculate that against total sales and net income and those types of financial metrics. But either way, the ones that hold closer to their historical values will lose less and have the potential to gain more, but the ones that are extremely speculative and growth opportunities, those will be the ones to fall and collapse, which will then bring down that broader market index, which will then make gold more attractive to the stock market. So keep that in mind. And I know that I've given you a lot of information in this video, but it's something that I have been working on and compiling over months on how to figure this out. I know a lot of you have asked, well, if we're going to have this collapse, what should we invest in? What do we need to do? In my opinion, you need to buy the asset that is undervalued. And I'm a big believer in asset and in value investing. Now, the way I have valued precious metals are undervalued. The way I have valued aggregate stocks, so if you buy ETFs on the stock indices, they are overvalued. It does not mean that you can't invest in the stock market and make a rate of return. You most certainly can, but you need to be investor savvy and knowing what to buy. Now, I need to make a disclaimer here before I wrap up. I am not a certified financial advisor. You need to seek one out if you are planning on investing in anything for the stock market, but I will make a disclaimer. I am long on precious metals. I do believe precious metals are the play in the long run, particularly during unstable times. That's just my opinion and recommendation. But again, I want you to do your own due diligent research and don't hesitate to seek out a financial advisor to see what they say. But if you have knowledge of sound economic principles and what's going on in the markets, use your best judgment as you see fit. No one is ever going to be perfect, and you can never, ever time this market, okay? Not even Michael Burry could do it when he made the bet against mortgage-backed securities in the 2000s and then made a fortune for his hedge fund, Scion Capital. So keep that in mind, but in my opinion right now, it is never a bet. There's never been a time in history where it has been better to own precious metals than now. If anything, just to serve as a wealth preservation status. And guys, that's all that I have for this video today. If you like my content, make sure you click that like button, show me some support, drop a comment, let me know what you think, ask me any questions. I'll try to get back to you as soon as possible. If I don't hear from you, if you don't hear from me, it is more than likely that I'm actually going to produce a video on that. And just like I've been seeing questions lately on where to invest or what do I think of this, I am looking at these markets right now. So if you have any questions, this is very complicated things, don't hesitate to leave one. I'll get back to you as soon as I can. Make sure you subscribe to my channel if you haven't. Click that notification bell so you can get access to insights on what I hope is unique economic information and helps you open your eyes to the kind of situations and circumstances that's going on in our markets now. Once again, guys, thank you for watching, and I'll talk to you next time.